You're neutral on China, or you were before we got the coronavirus outbreak. How has your view changed now, if at all?
So that's a 6-month view. So, depending on whether you're a trader or whether you're an investor for the next 6 months, and even for the longer term, we would even be more bullish because clearly there is a structural growth story. And so when we look at investing in China, it's very much focused on those longer term stories. So, for example, the rising middle classes, the healthcare demand, obviously, for more aging population, the education demand for the younger population, and so on. In the short term, we're not yet buyers. We think that there is just too much uncertainty at this point in time. Obviously the market had rallied quite significantly as well. Whether you look at the West or whether you look at China, part of the correction that we've had is that a correction from excessive rally in December and January on, an outlook for an economic cycle where people were looking for a V-shaped rebound. That's no longer the case.
Good to see you this morning, Willem. We reflect back to 2007. This is the worst opening for China since February the 27th, 2007. That was monikered as the Shanghai surprise. We are at the early stages of understanding the coronavirus and its impact. When you see the policy response this morning in terms of liquidity and short repo cuts, give me a sense of your reaction to that level of stimulus that's being pumped in today.
So what we believe is that we are clearly going to have an impact on GDP growth in the first quarter, but then later on, it all depends on how far this spreads, and we still need to learn much more about the disease to see whether that's going to have an impact on the second quarter as well. That being said, it really depends on whether you take that longer or that shorter term view. At this point in time, a little bit like what we saw even in 2019, it didn't really pay to buy the cheap stuff, to look at valuations only. It's very important to look at the fundamentals, and therefore I don't think people are going to start to bottom fish very quickly. People are going to take it with a little bit more caution. So our whole strategy for 2020, already before we knew about the coronavirus, was about, how do you manage the high valuations, almost the pricing for perfection, with all of the uncertainty that you're going to have. And there's not one magic formula, but diversification, alternatives, gold, etc. are important in the portfolio.
Yeah, I mean, we've seen China setting the yuan fixing stronger than 7 per dollar today. Also, we could start to question when the state-backed funds might start to step in and the national team will provide support after the big down day we've had for Chinese equities right now. If you're not bottom fishing, what are you watching for potential opportunities, even as it's difficult to talk about opportunities, of course, with a human crisis like this?
Yeah, so, I mean, you mentioned that the US is doing something very different than China in terms of, the stock market. Yeah. And then the commodities market, obviously, which is a very global market, but with the demand significantly being driven by, Chinese headlines and Chinese demand as a marginal factor. The commodities market has reacted quite significantly as well. So there, it's interesting to see whether there will be any response in terms of production cuts. Because if you look at oil stocks, for example, they shouldn't just be trading with the front-month contract. They should be trading with the whole curve. And if you have, longer dated contracts not moving that much because there is a supply response, then that could be an opportunity at some point in time. These kind of things are important to watch. If volatility starts to drift up from a longer-term perspective as well, and not just on the shorter term, there will be opportunities there.